And if you take your mind back to 2018, we were $80-90 per barrel, and it was, you know, everyone saying, yeah, knew it kind of thing. And before you knew it, 2 weeks time, we were down 50, I think even down to 40 in just such a short period of time. And such is the way markets correct. Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group. Today I'm joined with Vincent and Martha on the research team, and just a reminder to please like and follow where you can to support the channel. Right, Vincent, what do you think? Give us a summary of the last week. What's been going on in flat price?
It's been a really crazy one with flat price trending based on any headlines surrounding OPEC. The market is clearly in a wait and see mode, anticipating the OPEC meeting coming up this Thursday, which was initially supposed to happen over the last weekend, but was delayed on the back of potentially were allegedly quota disputes between some of the member states. So flat price has been oscillating around $80 in the front. On last Wednesday, just off the back of potential news of the delays, it did come off to 78 to 79, but has generally recovered up to $80 handles as of this week. The market is expecting OPEC, Saudi Arabia, to deepen their cuts, with the thinking that the risk reward is still skewed to the downside should cuts not be deepened because of the overwhelmingly bearish narrative at the moment, both from money managers as well as physical market sentiment, with North Sea physical differentials weakening substantially in recent weeks. Yeah, this is the past week, so any thoughts on the volatility? Volatility, I think day-to-day volatility actually, it depending on the day. For example, last Wednesday it was extreme, but after that, it hasn't really been too much. So really, it's seeming like the usual state is low volatility, but it's very prone to large swings if particular headlines come out, which would move the market. I would also add that because the market's in wait and see mode and thought they would have more of a direction by now, liquidity is actually low. Open interest down, people not wanting to take on risk. So when someone needs to come in and hedge, they're moving the market more so than they would do usually, because there's the less everyday volumes going on. Cool. So Martha, what about on the refinery margins?
Yeah, it's the same kind of story we've been seeing recently, as the refinery margin's been improving week on week due to crude weakness. And we've seen weakness all down the barrel in the products, and this kind of is being overpowered by the weakness in crude, so that we're getting an improvement of, I think, over $1 in the front month refinery margin. So we've got an improvement of over $1 in the week to the 27th, and we're just seeing weakness across all the products here. The usual suspects, we're seeing it from gasoil. The Asian refinery margin specifically is seeing huge weakness from Sing 10 ppm, and also EBOB's not had a particularly good week. We've seen good size selling from refiners and trade houses in the front spread, with, I think, maybe rolling positions, but also we've seen this really good size selling in Jan-Feb too, so I think they may be positioning to get short at these levels. Gasoil, it's been really quiet in the physical. The barges has been a lot more muted this week. There's a little bit of renewed interest from the German wholesalers, which was lacking last week, which was like a pretty significant bearish indicator, but it's back, but the window's still really thin in terms of participants. No real selling, and the premiums are pretty steady now. It doesn't seem like anyone's really piling into the position to hold it into pricing. There's no place. Sorry,
just to butt in there. That's interesting, because again, like what I was saying about Brent, about hedges coming in and there not really being the market to take it. Seems like it's similar in gas is essentially what you're saying. So yeah. Renewed buy side interest from German wholesalers, is that most likely linked to heating oil and the weather, or where's the German buying coming from, do you think?
I mean, it could be from the weather. I think this cold snap that we're kind of suffering through now has been fairly well forecast. So I think having the drop off and then jump back to kind of the physical market would not really be the weather due to like it being forecast like fairly well into the future, like it's not a big shock. I think it would rather be for maybe some sort of refining further.
Yeah, no, it's worth just like a speculation right on that, but
Yeah.
but at the same time we're seeing more support in LNG. Are you saying as well, or?
LNG, I think, probably get to in a second with like the one to watch.
Okay.
It's just really weak all round. Fuel, very low sulfur, got absolutely smashed last week in the east, and then that's brought it down in the west as well. And then high sulfur has been pretty quiet, and the strong east-west is pushing the barges down. So it's been a pretty pessimistic week, and we've not got really much to look forward to in terms of product strength. The Chinese export quotas that came out this time last year really was a massive support to gas oil, and we've been told that we're not going to be getting any more of those. And for the clean products, this has been dropped down to 2 million metric tons a month in November and December due to the weak margins. And this is kind of a self-fulfilling prophecy in that it's not going to inspire any kind of, it's not going to inspire the demand story because like there's no hope from China there.
Just talking about the VLSFO market, if we could get it up, that's the one that has been, shocking to the upside recently, like really serious rally on the cracks. And I guess the overall market. So it looks like on this graph, we can see you're saying it's the end of October for the Dec Jan spread. We had a really substantial rally, but then as long as it took to go up, probably half the time took to come crashing back down. So that was like a localized event ultimately. What are we retrospectively basing that upon? Was there new news, or was it just a bubble, something around pricing?
Yeah, so that was based on, actually we discussed this in the trade idea last week, as you might recall. It was all around the headlines surrounding the Al Zour refinery.
That was the reason for you being short?
Yes.
But what was the reason for the initial rally?
The initial rally
the market's
was,
justification?
Supply tightness as fundamentals, and then there was a lot of trade house buying in 7.5 and the spreads and the cracks, which really like bid the prices up. Definitely some short-covering flows alongside that as well, but that's a general sentiment as because there was a lack of cargoes arriving into East Asia. But
it seems like it's a very localized event, so ultimately it was probably correlated with some strong pricing in maybe October and early November. And then as we've kind of come out of that, it looks like it's crashing all the way back down. So if anything, this is just a classic. I mean, it looks just identical to a speculative bubble graph. As we built up, you kind of got a lot of enthusiasm for this, and then suddenly crashing all the way down, which proves it was whatever the justification was. It was essentially just localized buying and getting everyone hyped up, and then there was nothing really behind it, evidently. And I think we were talking about this not too long ago, like how it sustain itself. It's got to eventually materialize in the physical pricing for people to have the material belief that they continue to hold the contracts like down the forward curve. So if Oct price strong, then Nov pricing strong, okay, people believe Dec's going to price strong. But as soon as you get like weak physical signals and you're in an elevated level and you've got an overextended market, they just can't last forever. So that's a pretty significant event because what's been happening on the cracks?
So onto the cracks, similar decline has been seen in December 7.5 as well. So up to
just back down to reasonable levels, kind of $11-12 on the cracks. So I think from a margin perspective, I guess it is marginal on the overall margin, but at the same time, $6 per barrel on a crack is obviously going to have an impact. So that being eroded, as you say, Martha, is quite significant overall. It's, as much as it's still relatively healthy levels, if you compound that with the sell-offs we've been having in gas oil, that's quite a significantly bearish impact. So I mean, there's I guess this is the basis of our view going forward. Ultimately, everything seems poised for the downside on the crude markets, and again, maybe we'll just finish on that, but just the one to watch, let's say, going forward. I mean, what are we thinking, Martha?
So just going back to the LNG kind of issue that you brought up earlier. So I think yesterday afternoon, a few hours ago, so Origin Energy have announced there's going to be reduced gas supply into the Australian Pacific LNG. Basically, a tanker has docked and lost power, so it's delayed the LNG cargoes. It's deferred two of the cargoes. There were two cargoes waiting up by an island north of Australia, and so it's going to be blocking vessels in the future from entering the site. The vessel that's being like held there is meant to be going to China, and where there's like a good amount of like factory activity and where they need like lots of power and stuff. So there's the AP LNG plant that's got a capacity of 9 million metric tons a year of LNG, and it can only really take one tanker at a time. So we're looking at probably some pretty significant delays here from this incident, and the main customers that are going to be suffering are Sinopec and Kansai Electric. So there are 3 vessels scheduled for the like definite delays that are meant to be arriving in China. So it'll be really interesting to see like whether the market's going to jump on this as like a super bullish kind of like thing to go for, because I think the kind of cold weather that we're feeling now has limited effects, as it always does, but this could be something that the bulls could really get behind.
Yeah, we had the sensitivity in the market from the Australian strike and LNG, and given the events of last year, it is a more susceptible contract these days to kind of fear and price spikes, and I guess the geopolitical premium type concept as well, potentially. Having said that, doesn't look like it at the moment, but I guess that will be an interesting one. I guess we're sticking to niche, but trade ideas for the next week.
So my trade idea is looking into Q1, Q2 MOPJ swaps. MOPJ stands for Men of Platts Japan. It is the Asia benchmark for NAFTA. And so, of course, as we see on the chart here, it's been fluctuating over the past few weeks, and we expect the same trend to continue. There's a confluence of both bullish and bearish factors in the Asian NAFTA market, and so our trade idea, we're looking at range trading the Q1 versus Q2. So on the bullish side, you got like winter heating demand. This is peak seasonality, as well as very high notional values of FEI versus MOPJ. So therefore, we are seeing steam cracking demand for naphtha from steam crackers utilizing naphtha as feedstock. We have some end user demand, as well as supply tightness from delayed cargo loadings in Russia, as well as very fine PX MOPJ margins inducing some demand there. At the same time, there's some bearish factors, for example, poor olefins margins, weakening 92 MOPJ spreads, so less naphtha demand for blending, as well as naphtha-fed steam crackers in South Korea running below capacity. These are bearish factors. So it's very neutral. It is very range bound. So we don't have a particular directional act. So this is a very short-term trade. We're trading with the ranges, with the average true range around $4 at the moment. So price action seems to be fluctuating between 14 and 18. So essentially we are going with the trend, buying the lows and selling the highs.
Selling the highs and buying the lows, but either or.
Either or, yeah.
This is a new type of trade. You never really suggested this before. It's very interesting. So it's more of a day trader's probably trade, but ultimately, no, it's an interesting one. So I like the fact that you're not just trading off. It's not just simple as the volatility. It's range bound, then continue to trade at range bound. It's the fact that there's aggravated buyers and aggravated sellers, and the net result is a kind of balancing act. I guess which you're getting from the positioning data as well.
Yes, the positioning data it is quite balanced. There's no directional skew in either way. Recently has been more bullish in the overall naphtha complex, especially towards the front. We've been seeing this definitely recovery and strength from previous months.
What I would say is Q1, Q2 MOPJ was a pretty cyclical trade that would get bid up. It's just purely, I guess you could argue it's seasonal, but it was more the trade house interest in Q1, Q2 was always towards the long side. So maybe day trading that with a bullish axe on the range bound, but kind of taking profit 18, re-entering again. Maybe you could do that range bound trade, but always staying long, exiting, stay long would be my kind of addition to that, given the risk towards the upside and given what you're saying. Overall, it's kind of net bullish, if anything, but it's just an interesting anecdotal one. It's very niche, but a well spotted. But I think that we have to talk about crude, given where we are, right? And so those are all really interesting things that you may not have been aware of, and that's the great thing about what we're doing. Ultimately, things can get lost when there's such big macro headlines. There's a lot going on in the underlying market. But to go back to the macro market, wait and see mode doesn't mean nothing. If anything, it's like what's it in physics, when you have stored energy ready to potential energy, like there's a lot of potential energy in the market, so it could move into kinetic energy pretty soon, and like, you know, really could go either way if, you know, there's a collective sentiment. Ultimately, if people are ready to buy or sell and there's not much open interest, that means that they have the dormant risk capacity to enter. Having said that, I think everything we can see, it is heavily skewed to the downside. Like you said earlier, ultimately, if the OPEC don't actually cut from even where they are right now. So for example, well, what I'm trying to say is people are expecting an extension of the current cuts that we are in December. But I think we're saying even if we see that, there's still a skew towards the downside. And what will be needed is an actual cut from the current baseline. So Saudi at 9 million barrels per day, I think going down to 8.5, that kind of thing, could probably have what's needed to tighten things up again. But ultimately, they're not very willing to do it. It's quite clear. I mean, everyone's talking about this. They're not able to agree much. They're going to a Zoom-based call or digital call, I think. So that's, I mean, I can barely hear what people are saying on those things. I don't know how you're going to get like all these different countries to be discussing like that in an orderly manner and coming up with a decision. But I mean, that's, I love going back to that documentary Trader. Don't know if you guys have seen it. Paul Tudor Jones, like a legendary trader, macro trader. He traded like everything. Back in the day, I don't know, 30 years ago, he did this documentary where, and he actually regretted it and tried to buy every single copy and didn't want it being out there, but you can still find it online. And it's tracking him being a trader, and in one of them he's in an office and he's calling down to the pit trading floor and to a broker who you know, he's trading oil essentially, and it's during the OPEC meeting. And he said he's got a call from BP being like, someone's out there selling, you know, it could be the Saudis, could be the, and he's saying they don't realize, you know, wink wink, that's me. And his rationale was like, look, wild horses can't get me to bet against 12 men in a room trying to figure things out and come up with a decision, or whatever the amount of people was in the room. So obviously it's a very generalistic saying, but I think that in moments like this, when there's friction and there's so many different types of people, it is true. I mean, it's going to be very hard to come to a formal agreement. So you cut, or you cut, I don't want to cut, you know, and it's 3 years of cuts. So that all points to a decision either just being delayed or nothing, not material enough to move the market back up where it needs to be. And I think that's what we're saying. There needs to be proper intervention. And on the fundamental side, the fundamental story, the only thing, well, I think it's collective understanding now that non-OPEC supply is come back in force. Yes, US, but also like Brazil, Venezuela. I think no one can really say that there's a supply story here. So you have to point to demand, and the demand forecasts are needed to be in like the 3+ million barrels per day next year, and I don't think that's very believable by anyone. I don't think the macro sentiment is that believable next year on the bullish side, especially with what's going on with China. And so everything just points towards the downside and a big recorrection. And if you take your mind back to 2018, we were $80-90 per barrel, and it was, you know, everyone saying, yep, knew it kind of thing. And before you knew it, 2 weeks time, we were down 50, I think even down to 40 in just such a short period of time. And such is the way markets correct. I think that could be on the cards again, and markets tend to overcorrect either way, overbought, oversold. And I think we're in danger of that. And the only thing I would add is that $50 per barrel was the kind of agreed budget for Russia only a few years ago. And they were planning with that in mind. And I think OPEC were planning around keeping prices between 50 and 60. So it's not that ridiculous to go back to a $50 to $60 per barrel market. It's just because we've gotten used to these high prices in the last couple of years. But we've done a poll, haven't we, online? And Vincent, you want to talk about that a bit?
Yeah, so we had a poll from LinkedIn last week, thanks to everyone who voted. So the question was, amid the OPEC drama, what do you think will be the price of Brent crude going into year end? We had quite a few responses. The majority, 77%, was between 70 to 90. So 10% of you voted under 70, 37% 70 to 80, 40% 80 to 90, and 12% over $90 per barrel. So most of you are thinking somewhere in the middle of the range. Very conservative predictions here.
Yeah, I think it's quite interesting seeing the difference between that 3% of people choosing the 80 to 90 barrels over the 70 to 80. It's interesting to see whether there's that kind of weak bullish sentiment or just like the hope that it's going to be that rather than for any actual reason. Just people like those numbers, I guess.
Yeah. For me, seeing such ranges over the last 10, 11 years, it just isn't that big of a deal for the market to correct. I mean, we had a $10, $15 barrel sell-off in a week only a month ago. It doesn't take a hell of a lot. It does seem to take quite a lot on the upside. It tends to be a long, slow trend upwards in oil markets, and I guess that's why when we have bull markets, we tend to have lower volatility than the bear markets, which can be very aggressive. So buying puts, long dated puts, $50 per barrel, that kind of level for 2024. I mean, it's a bit of a teeny option type strategy, but why not? Ultimately that the risk reward is skewed that way, and you will get paid on the volatility increase or volatility spike as people will kind of pile in on that way. But I think we have to give. I mean, what would it take it to go back to 100? We have to kind of give that argument because people love talking about $100 per barrel.
Well, supply disruptions, further very deep OPEC cuts at the expense of market share. We're talking about realistic scenarios, right? Stronger demand.
In 2019, we had 10 million barrels blown away. In 2022, we had a war, drained inventories. We've had the most extreme, unrealistic scenarios you can think of, and oil didn't go above $100 per barrel for a very long time. So I just don't see it. I think what would have to change is possibly a bit of a shock on the macro side, which is a soft landing, interest rates being able to be lowered again next year, stock market rallies. I get it's very unlikely, but ultimately a very strong recovery in the economies around the world. China coming back online all at once, and suddenly people stop talking about the monetary tightening situation we're in, and we go on another bull cycle there. I think that is the best possible scenario, because then you would possibly get the demand increase. You at least get people very excited, and you would get macro investors piling in on the long side, and that enough could create some serious momentum. It's possible. I think only really in that scenario. Don't know if you guys agree.
Seems to be the macro side of things. Yet when flat price does go too high, going into the $100 range, that's when demand destruction. Central banks become wary. Okay, energy inflation.
Well, there you go. So yeah. Okay, let us know your thoughts in comments if you can, please, or on LinkedIn or wherever you choose to interact with us. And thanks for listeners, and thanks to Martha and Vincent for your time. And see you guys next week.
Thank you.